Okay, let's unpack this. Barclays, a name most of us recognize, recently unveiled their interim results for the first half of 2025. The official announcement is full of financial jargon, but our mission in this deep dive is to cut through all that, really extracting the most important nuggets of knowledge and insight. We're looking for the true story behind the numbers, the surprising facts, and what it really tells us about the health of this global bank, tailored just for you.
Exactly. And what's fascinating here is how these reports, which can often seem incredibly dense, actually reveal the strategic pulse of a massive global financial institution. We're not just going to, read figures. We're going to explore their recent performance, dig into their future targets, and truly understand how they're proactively managing risks in a dynamic and, well, ever-changing world. It really is about finding the signal in the noise.
Absolutely. So let's start with the big picture. Barclays Group's financial health in the first half of 2025. What do the top-line numbers tell us? Profit before tax jumped to a very solid £5.2 billion, which is a significant increase from £4.2 billion in the same period last year.
That's quite a leap.
It is. And their group return on average tangible equity, or ROE, which essentially tells us how efficiently they're using shareholder money to generate profits, that also improved nicely, climbing to 13.2% from 11.1%.
Right. Getting more bang for their buck, so to speak.
Exactly. And here's a standout detail I thought was interesting. Every single division hit double-digit ROTE in the second quarter of 2025.
Wow, every division. That is strong.
Yeah, that's a pretty strong showing. Overall group income increased by a healthy 12% year-on-year, reaching $14.9 billion.
Okay, so if we connect this to the bigger picture, these numbers indicate not just solid operational performance, but a remarkably strong financial footing for the group. Their capital strength, for instance, is particularly noteworthy.
How so?
Well, we're talking about a Common Equity Tier 1, or CET1 ratio, at a robust 14.0%. They even announced a $1 billion share buyback, which would still leave their CET1 ratio at 13.7% comfortably within their 13-14% target range.
Okay, so they have room to maneuver even with the buyback.
Precisely. And what's crucial here is that this robust CET1 ratio, especially when you think about upcoming regulatory changes like a Basel 3.1, well, it puts Barclays in a remarkably secure position. It's not just about weathering economic storms. It potentially allows them to be maybe more aggressive in future acquisitions or market expansion compared to less capitalized peers.
That's a powerful strategic advantage.
Okay.
And how about their liquidity position?
Also incredibly robust. Their liquidity pool itself increased significantly, up to $333.7 billion. That's up from about $297 billion at the end of 2024.
Wow.
Yeah, and more broadly, their liquidity metrics, things like the liquidity coverage ratio, or LCR, and the net stable funding ratio, NSFR,
Right.
they are substantially above regulatory requirements. This isn't just a pass. It indicates a significant buffer. It gives them robust protection against, say, sudden market liquidity squeezes or unexpected economic shocks. They've built up serious financial muscle there.
So we've seen a strong overall picture. Now, let's maybe drill down a bit. How are the different parts of Barclays performing? This usually gives us a more detailed view of their diverse operations and, where the real action is. Let's start with Barclays UK. Profit before tax increased 4% to $1.6 billion.
Okay, steady growth there.
Yeah, and total income was up 13% to $4.19 billion. Primarily driven, as you might expect, by net interest income. And also, significantly, the impact of their Tesco Bank acquisition completed back in November 2024.
Ah, yes, that integration would be feeding through now.
Exactly. One number that really jumped out at me from the UK business was their mortgage gross lending flow. It saw a massive 67% increase.
67%, that's huge.
Isn't it? Climbing to $15.4 billion in the first half of 2025 from $9.2 billion last year. What's driving such a substantial jump?
That's a fascinating leap. It seems like it was really a confluence of factors. You had reduced interest rates, making mortgages perhaps a bit more attractive,
Right.
increased operational capacity within Barclays itself to process more applications,
Okay.
and also that temporary boost from the stamp duty relief periods back in the first quarter.
Oh, okay. So a mix of things.
Yeah, and we're also seeing an increasing proportion of higher loan-to-value mortgages, those over 90% LTV, likely influenced, the report suggests, by the HMT Mortgage Guarantee Scheme, which is designed to help first-time buyers.
Interesting. So more activity with the higher LTV. And what about the risk side of that?
Well, credit impairment charges did increase. They went up to 237 million compared to just 66 million in the prior period.
Okay.
But it's worth noting that UK cards arrears rates remain remarkably low and stable, which suggests consumer resilience in that particular segment, at least for now.
Okay, good context. Let's move to the Barclays Investment Bank, or IB. It delivered a really strong ROTE of 14.2%, with profit before tax increasing to 3.01 billion.
Indeed. And total income for the IB rose by 13%. Global markets income specifically was up a robust 21% across FICC, that's fixed income, currencies, and commodities and equities.
So really firing on cylinders there.
It seems so. This indicates genuinely strong performance in their macro and credit divisions, alongside sustained strength in financing. Even in what was, let's face it, a quite volatile market environment in Q2, it tells us they navigated that turbulence very effectively.
But did they see higher impairments too?
They did, yes. Their credit impairment charges increased to 139 million, up from 34 million last year, primarily due, according to the report, to what they termed elevated U.S. macroeconomic uncertainty and also some specific single-name charges.
Okay, makes sense. Next up, Barclays Private Bank and Wealth Management, PBWM. This segment achieved an, frankly, eye-popping ROTE of 33.2%.
33.2%, that's incredibly high.
It really is. Profit before tax for this segment increased 18% to 234 million, and income was up 10% to 697 million. These gains were clearly driven by growth in client balances, strong net new inflows, and higher transactional activity. And their invested assets grew to 131.9 billion, showing solid expansion in what's obviously a key growth area for them.
Definitely a strong performance there. And over to the Barclays U.S. Consumer Bank, USCB.
Right. Their total income was up, but only a modest 1% to 1.687 billion. Net interest income was broadly stable.
Okay. And impairments, given the U.S. uncertainty mentioned for the IB.
Interestingly, despite that elevated U.S. macroeconomic uncertainty, credit impairment charges were broadly stable at 711 million.
Oh, okay.
Yeah, and their U.S. cards delinquencies also remained stable, indicating perhaps a managed risk profile there, or maybe the impact hasn't fully hit yet.
Interesting stability despite the headwinds.
Now, a key strategic point here. A co-branded card portfolio within USCB has been classified as held for sale, with an expected transfer in the first half of 2026. What does this signal, do you think, about their U.S. strategy?
That's a critical observation. Classifying it as held for sale strongly indicates a strategic streamlining of their U.S. consumer operations. It's likely about divesting non-core assets to focus resources on more profitable or strategically aligned areas. Or, potentially, it could be about bolstering capital ahead of those regulatory shifts we'll probably discuss shortly. It's definitely a move to optimize their portfolio.
Right, focusing the business. And finally, the head office. It reported a significantly reduced loss before tax, down to 247 million pounds, which is a substantial improvement from 461 million last year.
That reduction definitely signals active management, some efficiency gains at the center. It was primarily driven, the report says, by the non-recurrence of prior year losses from selling the Italian retail mortgage portfolio, and also the disposal of the German consumer finance business earlier this year. So it shows they're successfully shedding some non-core assets and streamlining those central operations.
So we've seen a mixed, but I think generally strong picture across their various arms. The investment bank and private bank truly shining, while the UK retail side saw significant growth in lending, albeit with some rising impairments. This diverse performance raises a crucial question. What does this tapestry of results tell us about Barclays' strategic priorities moving forward, especially when we look at their future targets?
Precisely. They're clearly looking to build on this momentum. For 2025, they're targeting a group ROTE of approximately 11%,
Okay.
aiming for greater than 12% by 2026. This means they expect to continue improving how efficiently they generate profit from their capital base.
And capital returns.
Yes, quite an ambitious capital return plan. They've set a goal to return at least 10 billion of capital to shareholders between 2024 and 2026.
10 billion.
Yes. And their preference, they state, is for share buybacks. The idea is to drive progressive dividend per share growth while keeping the total dividend stable overall.
And costs. Always a focus for banks.
Absolutely. They're targeting significant cost efficiency savings, around 500 million in 2025, and then a substantial 2 billion cumulative saving by 2026.
Those are definitely ambitious targets. How do they factor in those upcoming regulatory changes you mentioned earlier?
Ah, yes, that's a vital connection to make. These targets are absolutely set against the backdrop of significant upcoming regulatory shifts. For instance, the Basel 3.1 implementation, expected from January 2027, could increase their risk-weighted assets, or RWAs,
Right, the RWL?
by potentially $310 billion. Think of RWAs as the amount of capital a bank must hold against its assets based on how risky they are.
So higher RWAs mean more capital needed.
Exactly. And additionally, the planned shift for the U.S. Consumer Bank to an internal ratings-based, or IRB, model that has the potential to add another maybe $16 billion in RWAs. These are substantial changes that directly impact how much capital a bank needs to hold. It really highlights the strategic importance of meeting these efficiency and capital targets to maintain their strong position through that transition.
So it really underscores that it's not just about making money. It's about systematically managing this whole universe of potential risks to ensure stability and meet these evolving regulatory demands. This is where their Enterprise Risk Management Framework, or ERMF, comes in, right? It identifies 10 principal risks, things like credit risk, market risk, climate risk, operational risk, legal risk.
Mhm.
The long list. It's truly the backbone of modern banking, isn't it?
It absolutely is. And what's fascinating here when you dig into the report is how the bank proactively adjusts its impairment models. These aren't just, theoretical calculations plugged into a spreadsheet. They reflect real-world point-in-time uncertainties that might not be fully captured by the simpler models.
Like what, for example?
Well, for instance, they include provisions for customer uncertainty, like the risk of UK retail mortgage borrowers refinancing onto potentially much higher rates down the line.
Right.
They also account for the impact of that elevated U.S. macroeconomic uncertainty we talked about on retail credit cards and corporate loans, including, interestingly, potential cross-default risk for clients who took out those bounce-back loans during the pandemic. If those businesses struggle, it could affect other loans they have.
Right, a knock-on effect.
Exactly. And for calculating their expected credit loss, or ECL, which is essentially how much money they expect to lose on loans that might go bad, they don't just rely on one single forecast. They run calculations through 5 distinct macroeconomic scenarios, ranging from surprisingly optimistic, upside 2, upside 1, through a baseline down to downside 1 and downside 2, which are quite pessimistic.
So like stress testing for different economic futures.
Precisely. Think of it like a weather forecast, but for the economy. It allows them to anticipate how different conditions might affect their loan book. They factor in things like rapidly changing trade policies and uncertainty around potential tariffs and volatile geopolitical scenarios. It's quite comprehensive.
And market risk.
On the market risk front, their value at risk, or VaR, actually decreased by 21%, which, the report suggests, reflects their prudent risk positioning during the market volatility we saw in the second quarter of 2025. So they seem to have managed that exposure carefully.
Okay. That brings up a critical question, especially with interest rates being so, well, dynamic lately. How does a bank stabilize its net interest income in these fluctuating interest rate environments?
Yeah, that's a crucial part of their strategy. Barclays does this primarily through its structural hedge program. It's a key tool designed specifically to smooth out net interest income over time.
How does it work, in simple terms?
Well, think of it like the bank locking in a fixed income stream on a portion of its balance sheet. They use instruments like interest rate swaps. This essentially protects a chunk of their earnings from volatile rate changes, whether rates go up or down unexpectedly.
Got it.
And this program delivered significant gross contributions, nearly £2.8 billion in the first half of 2025 alone. So it demonstrates its effectiveness in stabilizing those earnings.
Okay, let's shift gears slightly to navigating the legal landscape. A global bank like Barclays consistently faces ongoing legal and regulatory matters. It's just part of the territory. The report outlines a variety of cases, things from civil actions related to old LIBOR manipulation allegations, the U.S. Anti-Terrorism Act, to disputes over motor finance commissions in the UK, and even UK VAT assessments by HMRC. It's a constant stream of complex challenges.
Absolutely. And while the report does state that the ultimate resolution of these matters isn't currently expected to have a material adverse effect on their overall financial position.
Right, the standard disclaimer.
Exactly. But it's vital for you as a listener to understand the inherent uncertainties involved. That's the key phrase. It means there can be no assurance about the precise impact on results, operations, or cash flows for any particular period. It's a necessary and nuanced disclaimer that highlights the unpredictable nature of these kinds of legal battles, even for a massive, well-prepared institution like Barclays.
It certainly emphasizes the scale and complexity of their global operations. But it's not all ongoing battles. They've also had some significant recent resolutions mentioned, like the conclusion of a shareholder derivative action in New York,
Okay.
and settlements reached with the UK's FCA just in July 2025 concerning financial crime systems and controls and anti-money laundering compliance. So these show continuous efforts to address compliance and resolve outstanding issues, which must be crucial for maintaining regulatory trust.
Definitely. Resolving these issues, even via settlements, shows progress and a willingness to engage and rectify past problems.
So we've journeyed through the quite intricate world of Barclays' recent performance. We've uncovered both their impressive growth in key areas, like the investment bank and wealth management, and the sophisticated ways they manage a complex web of risks and navigate a challenging regulatory and legal environment. We've seen a bank that's not just reporting numbers, but seems to be actively strategizing for the future, positioning itself for those upcoming changes.
I agree. These interim results offer a really compelling insight into how these global financial institutions operate day to day. They're constantly balancing ambitious growth strategies with the need for robust capital management and proactive risk mitigation in what is undeniably an unpredictable world. And perhaps this raises an important question for you, the listener, to mull over. Beyond the detailed numbers of just one bank, like Barclays, how do these insights into their operational resilience, their strategic agility, how they handle risk, how does that inform your understanding of the broader stability and maybe the potential vulnerabilities within the global financial system as a whole?